Hello friends, welcome back to Book Demystified once again, and today we're going to discuss about One Up on Wall Street by Peter Lynch. Now what if I told you that some of the best investment opportunities are hiding in plain sight, right in front of your eyes every single day? What if the key to beating Wall Street professionals isn't having access to expensive research reports or insider information, but simply paying attention to what's happening in your own life? You know what's absolutely crazy? While professional investors are sitting in their Manhattan offices analyzing spreadsheets and economic forecasts, the most profitable investment ideas might be staring at you from your local mall, your grocery store, or even your teenager's bedroom. I'm talking about companies that are about to explode in popularity, but Wall Street hasn't caught on yet because they're too busy looking at complicated financial models instead of real-world trends. Right now, as we speak, there are probably dozens of companies experiencing rapid growth that haven't been discovered by the big institutional investors yet. These could be restaurants expanding into new markets, retailers launching innovative products, or service companies solving problems that millions of Americans face every day. But here's the kicker. By the time these opportunities show up in professional research reports or financial news, it's often too late to make the really big money. This is where Peter Lynch's approach becomes absolutely revolutionary. Lynch managed the Fidelity Magellan Fund from 1977 to 1990, and during that time, he delivered an average annual return of 29%. To put that in perspective, if you had invested $10,000 with Lynch at the beginning and just left it alone, you would have ended up with over $250,000 13 years later. That's not a typo. He turned $10,000 into $250,000 by consistently finding opportunities that other investors missed. But here's what makes Lynch different from other legendary investors. He didn't do it by being smarter than everyone else or by having access to secret information. He did it by using his natural advantage as a regular person living in the real world. He paid attention to what products his wife and kids were using, which stores were always crowded when he went shopping, and which companies were solving real problems in ways that customers loved. Lynch's whole philosophy is built around this idea that ordinary investors actually have significant advantages over Wall Street professionals, but most people don't realize it or know how to use these advantages effectively. Think about it. You probably spend more time in retail stores, restaurants, and shopping malls in a month than most Wall Street analysts do in a year. You see which products are flying off the shelves, which stores always have long lines, and which new services are making your life easier. But instead of trusting our own observations and experiences, we get intimidated by the investment world and assume that the professionals must know something we don't. We ignore obvious opportunities right in front of us while chasing after whatever stock tip we heard on CNBC or read about in some financial newsletter. I learned this lesson in a pretty embarrassing way back in college. I was working part-time at a Starbucks, and this was around 2010 when the company was really starting to explode nationwide. Every single day, I watched lines of customers willing to pay $4 or $5 for coffee drinks that cost maybe 50 cents to make. I saw how loyal customers were, how they'd come in every morning like clockwork, and how the company was opening new locations seemingly every week. Did I think to buy Starbucks stock? Of course not. I was too busy reading about complicated investment strategies and trying to find the next hot tech stock that some guru recommended online. Meanwhile, the best investment opportunity was literally right in front of me every shift I worked. If I had just invested $1,000 in Starbucks stock back then and held it until now, it would be worth over $10,000 today. That's exactly the kind of opportunity that Lynch talks about throughout his book. He calls these 10-baggers, stocks that increase 10 times in value, and he found dozens of them by simply paying attention to successful businesses he encountered in his everyday life. One of Lynch's most famous discoveries was Dunkin' Donuts, which he found not through sophisticated financial analysis, but because he noticed how popular the chain was becoming near his home in Massachusetts. He saw the long lines, the customer loyalty, and the rapid expansion, so he bought the stock. It ended up being one of his most profitable investments, returning over 10 times his initial investment. Another classic Lynch story involves Hanes, the underwear and pantyhose company. He discovered this opportunity when his wife mentioned that a new product called Legs Pantyhose was becoming incredibly popular with women because of its innovative packaging and convenient availability in grocery stores. Lynch bought the stock based on this real-world observation, and it became another huge winner for his fund. Now, Lynch doesn't just tell stories about his successes. He breaks down exactly how ordinary investors can systematically identify these opportunities before Wall Street catches on. He divides potential investments into 6 different categories, and understanding these categories is absolutely crucial if you want to find your own 10-baggers. First, there are slow growers. These are large, mature companies that grow roughly at the same pace as the overall economy. Think companies like Coca-Cola or Procter & Gamble. They're not going to make you rich quick, but they're steady, reliable, and often pay decent dividends. Lynch suggests that these stocks are fine for part of your portfolio, but they're not where you'll find the big opportunities.
Next are stalwarts. These are large companies that grow faster than slow growers, but aren't explosive growth stories. Companies like McDonald's or Home Depot might fit this category. They can be good investments and occasionally provide solid returns, but again, they're not typically where you'll find 10-baggers. Then there are fast growers, and this is where things get exciting. These are smaller companies growing at 20 to 25% per year. If you can find a fast grower early in its growth phase, before it becomes too large or well-known, you might have found your 10-bagger. The key is finding these companies while they're still small enough that rapid growth can continue for many years. Cyclicals are companies whose fortunes rise and fall with economic cycles. Auto companies, steel producers, and airlines often fit this category. Lynch shows how you can make money in cyclicals, but the timing is crucial, and you need to understand where the company is in its cycle. Asset plays are companies that own valuable assets that aren't reflected in their stock price. This might be a company with valuable real estate, natural resources, or other assets that the market is undervaluing. These opportunities require more detective work, but can be incredibly profitable when you find them. Finally, there are turnarounds, companies that have been beaten down but are in the process of recovering. These can be very profitable if you can identify genuine turnarounds early, but they're also risky because not all troubled companies successfully recover. Lynch emphasizes that the biggest opportunities for individual investors usually come from fast growers and turnarounds, categories where your real-world observations can give you a significant advantage over professional analysts who might be too focused on financial metrics to notice changing business fundamentals. But Lynch doesn't just want you to randomly buy stocks based on casual observations. He provides specific criteria for evaluating potential investments, and this is where his approach becomes both systematic and accessible to ordinary investors. For fast growers, Lynch looks for companies with several key characteristics. First, the company should have a simple business model that you can easily understand. If you can't explain what the company does in 1 or 2 sentences, it's probably too complicated. Second, the company should have room to grow. A fast-growing company that's already saturated its market probably isn't a good investment anymore. Third, the company should have some sustainable competitive advantage. This might be a strong brand, a unique product, an efficient distribution system, or some other factor that prevents competitors from easily copying their success. Fourth, the financial metrics should support the growth story. Lynch wants to see consistent earnings growth, reasonable debt levels, and evidence that the company is actually making money, not just growing revenues. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI. The link's below. Every bit of support helps us keep creating valuable content for you. One of Lynch's most important insights is about the relationship between a stock price and the underlying business performance. He shows that over time, stock prices follow earnings growth. If a company can grow its earnings at 20% per year, the stock price will eventually reflect that growth, even if it takes the market a while to catch on. This is why Lynch focuses so much on finding companies with strong earnings growth potential, rather than trying to predict short-term stock price movements. He's not trying to guess what the stock will do next week or next month. He's trying to identify businesses that will be much more valuable in 3 to 5 years. Lynch also teaches investors how to spot warning signs that might indicate a company is running into trouble. These include things like excessive debt, declining margins, increased competition, or management making questionable decisions. Learning to recognize these red flags is just as important as learning to spot opportunities. One warning sign that Lynch particularly emphasizes is when a successful company starts diversifying into unrelated businesses. He calls this diversification and shows how it often destroys value rather than creating it. When you see a restaurant chain trying to become a clothing retailer or a technology company buying unrelated businesses, that's often a sign to be cautious. Another red flag is when Wall Street gets too excited about a stock. Lynch points out that once every professional investor and financial media outlet is recommending a stock, most of the easy money has probably already been made. The best opportunities are usually in companies that haven't attracted widespread attention yet. Lynch's approach to research is refreshingly practical and accessible. Instead of requiring you to analyze complex financial statements, he suggests starting with simple observations and then doing basic research to confirm your thesis. If you notice a retailer that's always busy, find out if they're expanding to new locations. If you love a new product, research the company that makes it and see if they have other successful products in their pipeline.
He also emphasizes the importance of visiting companies and talking to management when possible. This doesn't mean you need to set up formal meetings with CEOs, but if you're considering investing in a retailer, visit their stores, talk to employees and customers, get a feel for how the business actually operates at ground level. This real-world research often provides insights that you can't get from reading financial reports. You might discover that a company's stores are always empty despite good financial results, which could be a warning sign. Or you might find that a company with mediocre numbers is actually executing a brilliant strategy that hasn't shown up in the financials yet. Lynch shares the story of how he discovered Taco Bell by simply eating at their restaurants and noticing how popular they were becoming. He talked to store managers, observed customer behavior, and concluded that the company was positioned for rapid growth. His investment in Taco Bell's parent company generated returns of over 12 times his initial investment. One of the most valuable sections of the book deals with Lynch's approach to portfolio management. Unlike some investors who concentrate their holdings in just a few stocks, Lynch typically owned hundreds of different stocks in his fund. This might seem like too much diversification, but Lynch explains that when you're looking for 10 baggers, you need to accept that many of your picks won't work out as expected. His strategy was to make many small bets on promising companies, then increase his positions in the ones that started performing well, while cutting his losses on the ones that didn't work out. This approach allowed him to capture the enormous gains from his successful picks, while limiting the damage from his mistakes. For individual investors, Lynch suggests owning somewhere between 5 and 10 stocks, depending on how much time you can dedicate to research and monitoring. This provides enough diversification to protect against individual company problems, while still allowing you to benefit significantly from your best picks. Lynch also provides practical advice about when to buy and sell stocks. His general rule is to buy more of a stock when the underlying business is performing well and the stock price is reasonable relative to earnings growth. He's not interested in trying to time the market or predict short-term price movements. For selling, Lynch has several criteria. He'll sell if the original reason for buying the stock no longer applies. For example, if a fast grower has saturated its market and can no longer maintain rapid expansion. He'll also sell if he finds a better opportunity elsewhere, or if a stock becomes dramatically overvalued relative to its earnings prospects. But Lynch cautions against selling too quickly just because a stock has gone down in price. Some of his best investments went through periods where they performed poorly before eventually becoming 10 baggers. The key is to distinguish between temporary setbacks and fundamental problems with the business. One aspect of Lynch's philosophy that really resonates with me is his emphasis on staying within your circle of competence. Rather than trying to understand every possible investment opportunity, focus on industries and companies that you can actually comprehend based on your own knowledge and experience. If you work in healthcare, you might have insights into which medical device companies are developing innovative products. If you're a teacher, you might notice which educational technology companies are actually helping students learn more effectively. If you're a parent, you probably have a good sense of which toy companies are creating products that kids genuinely love. Lynch shows that these real-world insights can be incredibly valuable if you know how to translate them into investment research. The key is not to assume that your observations automatically mean a stock is a good buy, but to use them as starting points for deeper investigation. This approach requires patience because the best opportunities often take time to play out. Lynch found that his most successful investments typically took several years to reach their full potential. During that time, the stocks often went through periods of poor performance that tested his conviction in the underlying business. I think about some of the obvious opportunities that have emerged over the past decade that individual investors could have spotted early. Netflix was clearly disrupting the video rental industry years before most Wall Street analysts understood the implications. Amazon was obviously building something revolutionary in e-commerce, but many professional investors dismissed it as overvalued for years. Apple's transformation under Steve Jobs was visible to anyone paying attention to their product launches and customer reactions. In each of these cases, ordinary consumers could see the writing on the wall long before it showed up in quarterly earnings reports. The challenge is having the confidence to act on your observations and the patience to hold on while the market catches up to your insight. Lynch also addresses some of the psychological challenges that prevent most people from successfully implementing his approach. One major obstacle is the fear of looking foolish. It's much easier to buy a stock that everyone else is recommending than to invest in a company that you discovered through your own research but that no one else is talking about.
Another challenge is the tendency to sell winners too early and hold losers too long. When a stock you bought at $10 reaches $15, it's tempting to take your profit and congratulate yourself on a job well done. But if the underlying business is still growing rapidly, that stock might eventually reach $50 or $100. Conversely, when a stock drops from $10 to $7, most people want to hold on, hoping it will come back to break even. But if the business fundamentals have deteriorated, that stock might eventually go to zero. Lynch emphasizes the importance of basing these decisions on business performance rather than stock price movements. Lynch's track record speaks for itself, but what makes his approach particularly valuable is that it's replicable by ordinary investors. You don't need an MBA from Harvard or access to sophisticated research tools. You just need to pay attention to the world around you and be willing to do basic research on companies that catch your interest. The most important thing to remember about Lynch's strategy is that it's not about finding one perfect stock that will make you rich overnight. It's about consistently identifying good businesses early in their growth phase and being patient enough to let them compound over time. As we wrap up our exploration of Lynch's wisdom, let me share the key takeaways that can transform how you think about finding investment opportunities. First, use your natural advantages as a consumer and observer of everyday business trends. You encounter more potential investment ideas in a typical week than most Wall Street analysts see in a month. Trust your observations, but always back them up with research. Second, focus on businesses you can understand. If you can't explain what a company does and why customers would choose their products or services, it's probably not a good investment for you, regardless of what the financial metrics show. Third, look for companies with room to grow. The best opportunities usually come from smaller companies that are expanding rapidly but haven't yet attracted widespread attention from institutional investors. Fourth, pay attention to the financials, but don't let them overwhelm the business fundamentals. A company with strong earnings growth, reasonable debt, and a sustainable competitive advantage is usually a better bet than a statistically cheap stock with declining business prospects. Fifth, be patient and think long-term. The biggest gains come from holding great companies for years, not from trading in and out based on short-term price movements. Sixth, diversify appropriately. Don't put all your money into one stock, no matter how confident you are. But don't over-diversify to the point where your best ideas can't meaningfully impact your results. Finally, be prepared for volatility and occasional mistakes. Even Lynch's fund had periods of poor performance, and not all of his stock picks worked out. The key is to learn from mistakes and stay focused on finding businesses with strong, long-term prospects. Peter Lynch's approach isn't just about making money. It's about developing a mindset that helps you see opportunities everywhere you look. Once you start thinking like Lynch, you'll never walk through a mall, try a new restaurant, or use an innovative product without wondering whether the company behind it might be a potential investment. The beauty of Lynch's philosophy is that it turns everyday experiences into potential learning opportunities. Instead of just being a consumer, you become an investor detective, constantly gathering intelligence about which businesses are thriving and which ones might be the next big thing. Remember, some of tomorrow's most successful companies are probably small, relatively unknown businesses today. They might be serving customers in your neighborhood, solving problems you've experienced personally, or creating products that you've recently discovered and loved. The question isn't whether these opportunities exist. They definitely do. The question is whether you'll develop the skills and mindset to recognize them when you encounter them, and whether you'll have the courage to act on your insights when everyone else is still overlooking these companies. Lynch proved that with careful observation, basic research, and patient capital, ordinary investors can achieve extraordinary results. His approach doesn't guarantee success, but it provides a proven framework for spotting opportunities before Wall Street discovers them. So there you have it, friends, Peter Lynch's blueprint for getting one up on Wall Street by using your natural advantages as a real-world observer of business trends. The opportunities are out there, hiding in plain sight. The question is, will you be the one to spot them first?